You're a hardcore investor. I want to think about rates dropping from the investor perspective. Walk us through what you think in regards to rates dropping for multifamily properties, what people should be doing. Because what is so funny today is when cap rates in multifamily was at the lowest they've ever been in history because debt was so cheap, people were throwing money at multifamily and investment projects at land development. Now that cap rates have risen and they're getting a higher return, but because the debt is more expensive, they're all of a sudden all conservatives going, I don't know. And I'm thinking, these are better assets in 2024 than they were in 2022. We're getting a better return. This is a buy signal. So walk me through some numbers in regards to this. Let's educate people a little bit more.
So the really great thing about multifamily is being able to force appreciation. And we can do that through a number of ways. And one of which will be forced whether we do anything or not. And it's the cost of debt. The cost of the mortgage doesn't go into the NOI or the cap rate, but it's in the investor's head, right?
Yes.
And so that's what makes them make a decision to pay a higher or lower cap rate, right? Is how much is going to cost me? How much I need to feed this place or how much is going to make me? Like I just did some numbers because we had a client looking for $1 million multifamily. They did 25% down if the cap rate or the rate was 6.5, rents were about 8,000, expenses were around $2,000. Taxes, insurance, blah, blah, blah. The NOI in that case was about $58,000 a year. And that resulted in a cap rate of 5.84. Right? Which is, I think, about what we're seeing in the market today. Would you agree?
Totally. Okay. Yeah, the whole Seattle Metro. Absolutely.
So if instead, because rates do come down, now that cap rate comes down to just say 4.5. I mean, I was seeing things in Seattle traded in the 3s.
Oh,
right?
There was a deal that we got asked to make an offer on that was 2.8 and it was a multi-million-dollar deal. So we're talking big commission for us. And I told the investor, I said, bro, I'd never buy this. And he goes, seriously? I said, I understand you want to buy in Seattle? I'm going to go right outside here to one of the burbs and let's just go get a better deal.
That's bonkers, right? and I mean, some place across the country, you might say 4.5 and they're like, never. But it absolutely was like, that was a deal.
That's a good deal
in Seattle,
yes,
right?
Absolutely.
And so if that cap rate, nothing changes. Rates don't go down. You don't trim expenses, don't raise rents, nothing. That cap rate goes to 4.5. The value of that property goes up to $1.3 million.
So you make $300,000 or 30% on simply the cap rate changing. And the reason that cap rate starts to change is because just like the stock market, the real estate investor is a forward-looking thinker. And so as rates start to come down, they go, oh man, I can pay a little more for this property. And they start paying more and cap rate compression starts all over again.
That's right. And get this, right? Like that's not a 30% increase. That's not a 30% gain. It's like 100% gain. Because on my $1 million purchase, I put 25% down.
Oh, amen. Yes.
So I put 25% down. I'm into this thing for $250,000 for down payment. I got appraisal and title and that's maybe I'm into it for $300K. And I made $300K in a year. So my rate of return is 100%. I gained 30% on the value, but my rate of return, my ROI is 100%. Now, let's say rates come down a percentage point. You trim expenses from 25 to 20% because you're a good operator. You raise rents from 8,000 to 9,000 and cap rates go to 4.5. Now the value of that building is 1.6.
Oh my.
Right. So you trimmed expenses by $200 a month and you raised rents by $1,000 a month. And you gained another $300,000 in value. Multifamily forced appreciation is absolutely where it's at.
And so this is one of those things where, once again, I love the discussions we get into on the internet. They're like, I would never be a landlord. Just put it in the S&P 500. Where are you going to get $600,000 from your $250,000 in a year and a half to 2 years?
NVIDIA. That's probably it.
But if you were
one time in the last 10 years,
if you were lucky,
and you're super lucky, right? And you rode it the whole way, right? Because most of the time you spend you buy a stock for $10,000 and it goes to $20,000 in 2 months. You're like, I better ring the register.
Yes,
and plenty of people did. They got out and maybe they got back in, right? And then you play that game, but there's no place to do this, right? Then you talk about the tax advantages, and then you talk about the actual cash flow from the outside as well, right? It's very difficult to replicate this in a stock pick. Especially when NVIDIA is one of 5,000. Right? Like, and there's probably a few other ones that have ripped like they have, but that's the big one in the news, right? So, I mean, it's very difficult to have that kind of increase. This is why I love the game of real estate.